Everybody these days are telling us how to grow our capital. But in today's inflationary environment, don't forget about the most important rule Warren Buffett teaches us: never lose money. Now, he didn't mention anything about real estate, mutual funds, stocks, bonds. Instead, he starts with not losing what you already have. In today's video, we're going to discuss what it means to preserve your capital, some key considerations you should know, some of the disadvantages you may run into, and the top 5 ways you can get started in preserving what you already have. If you're new to this channel, I'm Dr. Jeff Anzalone, Louisiana periodontist that wants to teach you how to exit the rat race by acquiring multiple streams of income besides your earned income. I've got a passive income guide that you can download with the link below this video. Now, I was at the gym recently, and a friend of mine that's getting his MBA, he told me that he actually got a $10,000 gift from his grandmother. He was kind of going back and forth. Where should he put it? Should he put it in the stock market, into a CD, maybe start off on some real estate? He wasn't really sure what to do. And it really seems that a lot of new investors, they get so hung up on the returns, yet they have little to no money saved. Who cares about earning 8% or 12% on $10,000? Think about it. Is the difference between $800 or $1,200 that big of a deal at first when the value of your portfolio is so low? I don't think so. Yet, many people spend all of their time initially focused on the wrong things. In my opinion, we should be focused on getting better at our careers, providing more value to inevitably increase our income, so then we can invest more for the future. Something else to consider: we're told by financial advisors that we need to accumulate millions and millions of dollars in our retirement savings. Initially, I was told $9 million. If that's the financial strategy you want to pursue, get rich slowly, then not losing what you begin to accumulate should be an important part of your investment decisions. As a side note, I don't need anywhere near $9 million because we're investing in cash flow using real estate syndications. Now, a common question new passive investor circle members ask me is about the rate of return that they can expect investing in the real estate deals that I invest in. Again, returns are important to investing, but there's something else that I look at before investing in a particular project. That's right, I'm talking about what we're going to be talking about today: capital preservation. Whenever I invest my money in a real estate syndication, I want to do everything I can to make sure that I won't lose money before I get into that deal. Even if I don't get the expected returns, I want to be sure that I can at least get the original investment back. But as you know, nothing in life is certain. So let's start off by first defining what exactly is capital preservation. Well, capital preservation is an investment strategy focused on preserving capital to help prevent the loss of your portfolio. Basically, in layman's terms, is, it's all about playing safe. Typically, this type of investment is meant to be a short-term strategy, and it's for those that are typically nearing retirement or investors wanting a safe place to park their money. Now, the capital is usually kept in things such as bank accounts, CDs, savings bonds, as these investors tend to be risk averse. An example would be somebody in the early 70s planning to retire at the end of the year. This person would normally choose to give up potential returns in exchange for the security of their current savings, as they want to access it whenever they need it. If this is the case, then there are certain things that should be considered when choosing this type of investment strategy, like, of course, lower risk investments. Let's take a look at a few of the key considerations when it comes to preserving your capital. If you're thinking about a conservative approach and selecting assets for capital preservation, then the main key consideration is volatility. Volatility is basically the fluctuation in value of your securities. It's also important to take into consideration what exactly is your time horizon. For those that need immediate access to your money, again, I'm a periodontist, not a financial advisor, so don't take any of this as a financial advice. I'm just giving you, after I have researched this for hours and hours, I'm giving you what is recommended out there, the most popular thing. So for those that need immediate access to their capital, consider investing in safe assets such as those that are FDIC insured, Typically, they'll insure your money up to $250,000 in things such as checking accounts, savings accounts, and money market funds. Now, if if your money will not be needed for, let's say, like a few months, then you want to consider again money market funds, CDs, treasury notes, and short-term treasury bills. The US Treasury also sells TIPS, or inflation protected securities, which offer both capital preservation and immunity from inflation. Now, if your money isn't going to be needed for a few years, then you can consider investing in short-term municipal bonds, short-term corporate bonds, US savings bonds, or US agency bonds. All right, let's talk about the main disadvantage of investing for capital preservation. Well, as you can imagine, the biggest drawback of this strategy is when inflation goes up. That's right, when inflation rises. Even though fixed income investments are generally safe and promise foreseeable returns, inflation can completely wipe out those returns. As you know, $100 today will not have the same purchasing power 30 years from now. This is due to the fact that time erodes the value of money. The longer a capital preservation strategy is employed, the more likely inflation will diminish the value of your securities, thus giving you a lower yield. For example, index funds typically average a 7% annual return, yet capital preservation assets usually rely on a much lower interest rate, like around 2 to 3% or so. This is the main reason that this type of strategy is usually recommended, typically, like we said, on a short-term basis. Now, let's talk about capital preservation when it comes to real estate investing. Now, one of the main investment strategies that I personally use is passive real estate syndications. Now, as a busy professional, I don't have time to treat patients and deal with tenants. Being a landlord is something that I do not want to do at this point in my career. Now, with regards to real estate, I invest with a sponsor or a general partner that actually leads the syndication. They're the ones that they find the deals, they manage the deals, then they sell them after the projected hold period. One of the reasons why I invest in these deals is capital preservation. Who wants to invest $100,000 in a project and lose it? Nobody, right? So yes, the returns are important to me, but I want to do everything that I can to make sure that my money is protected. So let's get into the 5 capital preservation pillars that are at the core of every real estate syndication deal that I invest in and that I look for when investing in deals. The first one is this: cash reserves. One of the first recommendations I have for people starting off in their careers is to initially set up an emergency fund. As you know, unexpected events will show up, and we want to make sure that we're prepared when that happens. This is no different when it comes to real estate. Unexpected things happen, and it's important to have cash reserves in place for when that does. It's also important when purchasing a property, you have to factor in for the CapEx, or the capital expenditures, such as renovating the units. This should be something that the sponsor of the syndication is going to do. And most of the syndications that I've invested in are what's called value add projects. And cash flow can vary month to month based on things like the occupancy and the maintenance costs. You want to watch out for sponsors that expect to rely on monthly cash to cash returns to pay for these capital expenditures. Now, what happens if the unknown occurs, such as like an HVAC unit goes out that wasn't predicted in the business plan? Now, these are some of the things you need to think about, and I want to make sure that I ensure in the deals that I invest in that there's a certain amount of capital set aside for these what ifs. This allows the cash on cash returns to go directly to you, the investor, and not have to fund these what if scenarios. Moving on to number 2, cash preservation pillar is purchase cash flowing properties. Now, after the capital reserves budget has been addressed, the next way to ensure capital preservation is by investing only in these cash flowing assets from day one. You want to do this even if the group doesn't have to improve the property. The reason being is that any income generating property is going to add a layer of protection to any capital investment. If worse comes to worse, and the business plan that's been put into place has to be placed on hold, the sponsors can hold the property and it would still be cash flow positive. Number three, the good old stress test. Typically, a good business plan showcases not only the best case scenario, but also the worst case scenario as well. By doing this, the sponsor can develop a plan for the worst possible events that can take place. Basically, what they're trying to do is answer the question, what happens if things don't go according to plan? Most pro forma or future projection of a property's cash flow or net operating income should take in consideration if certain unexpected issues happen. These could be things such as if the vacancy rates drop 15%, or if you have some sort of natural disaster that damages 30% or more of the property that you're invested in. If issues such as this happens, we want to know how it would ultimately end up impacting the cash flow. By conducting multiple stress tests of the investment, we can test our assumptions and make sure that the investment can weather tough conditions. Number four, the exit strategy. Very similar to the stress test, developing multiple exit strategies is a very crucial piece of preserving capital. Even if the sponsor is projecting the project to have like a 5-year hold period, much can change in the market and in the property itself. So having multiple strategies in place allows the sponsor to account for such things as contingency plans in case the property needs to be held longer than expected, and then preparing to sell, preparing the property to sell to different types of end buyers, whether that's going to be a private investor, institutional buyer, something like that. All right. And last but not least, number five, you want to work with an experienced team that's focused on capital preservation. One of the most crucial parts of having a capital preservation strategy is working with an experienced sponsor that actually values capital preservation. You also we want to look for a team that has a strong track record of success. You want to work with a group that knows what they're doing once something unexpected pops up. The key is that they know how to navigate the situation and are always operating from a place of protecting you, the investor's money. As you begin to review different investment options and opportunities and determine how to best invest your money, always, always, always consider capital preservation. Projecting high returns, yeah, it looks nice, yet hedging the downside risk should also be a strong consideration. Speaking of hedging against risk, have you thought about hedging against something that's completely eroding your cash, that's sitting dormant in your accounts right now? If so, then you need to check out this video where we're going to talk about what you can do while feeling the sour effects of inflation.